Hello, my friends. Today is August 23rd, and this is Markets Weekly. So, this past week was an action packed week, so we have a lot to talk about. Now, the week began with a historic meeting between President Trump and President Putin in Alaska to discuss the Ukraine war. A few days later, major European leaders, including President Zelensky, flew to Washington to discuss the Ukraine war. Now, this itself would have been a very historic meeting, a lot of stuff going on. But because the White House has a flood the zone strategy, there's just so much going on that it was forgotten basically midweek. Now, the conclusion seems to be that peace in Ukraine is going to be very difficult, but the president also doesn't seem to want to impose secondary sanctions on Russia, so the market and economic impact of a lack of peace doesn't seem to be very large. Now, earlier on in the week, we had some concerns that the AI bubble may be deflating. Tech was basically leaking lower for 4 days in a row, but that was saved by the Jackson Hole speech, where Jay Powell seemed to be a bit more dovish than the market expected. And of course, during the week, we had very interesting developments in the US's industrial policy, where the US is taking a 10% stake in Intel. All right, so today let's first talk a little bit about the deflating of the AI bubble, and then let's talk about Jackson Hole. And I think we have to talk probably a lot about this because I'm seeing some very concerning takes about this on Twitter. And lastly, let's talk a little bit about the US's industrial policy. All right, starting with the AI bubble. And yes, it is a tremendous bubble that I wrote about last week in my blog. And of course, bubbles doesn't mean it's going to go down. To be perfectly clear, it can go higher and higher and higher than you can ever imagine. But there is, I think, growing awareness that we are in a definite AI bubble, and that's beginning to have some impact on the market. So first off, we had an interview with AI godfather Sam Altman, where he was pretty candid that, yeah, it's probably a bubble, and probably a lot of people will lose a lot of money, but yes, this is great technology, and it's going to change the world. And I think all those are totally correct. It is great technology. It is going to have a big impact on the world, but doesn't mean stock market is going to go to infinity. Now, there was also another interesting study picked up by Forbes on a Monday that seemed to spook the market, whereas the study finds, this MIT study finds that the AI implementation by the corporate sector actually is basically not super helpful. It finds that about 95% of AI implementations have no return on investment. So, whereas AI, again, promising technology at the moment, just isn't really helping corporations very much, at least the vast majority of corporations. There's also a report that right now there are almost 500 AI unicorns. A unicorn is a startup valued at more than $1 billion. 500, that's a pretty big number. And again, another strong indication that this is definitely some kind of bubble. Now, to be clear, when we're looking at, say, comparing the AI bubble to the dot-com bubble, during the dot-com bubble, many people, if not everyone, knew that it was a bubble. In fact, you had very, very prominent media outlets like Barron's writing articles back then, back in 2000, telling everyone that, guys, this is probably a bubble. Doesn't mean it can't go higher. But I think, though, personally, the way that I look at this is that information takes time to disseminate throughout the markets. You have participants with varying degrees of expertise. The more dissemination you have, and of course, when price cooperates, of course, is when you begin to get that realization that, maybe number doesn't go up forever. Now, I recall, not too long ago, we had a bit of a scare with DeepSeek, a Chinese AI company, potentially because they came up with a product that was much more efficient, will reduce demand for NVIDIA chips. Now, that DeepSeek news actually was well understood by people in the AI space weeks in advance, but only suddenly became a common knowledge at some point and had a market impact. So again, it takes time to disseminate information. This past week, I noted that my favorite independent news outlet, Breaking Points, actually had a segment on the potential AI bubble. So I think that knowledge is disseminating. Doesn't mean it can't go higher, guys, just to be totally clear. But I definitely think that we are in a bubble. So hopefully, again, we're all prepared for what could happen. However, although prices in tech did leak lower the first few days, there was a tremendous surge in Friday after Chair Powell's Jackson Hole speech. Now, heading into Jackson Hole, my expectation was we wouldn't really get much change or anything newsworthy. The reason I was taking this is that we still have a lot of data between now and the September meeting. Again, we have non-farm payrolls, we have CPI, and of course, there's a lot of disagreement on the FOMC. You have people who are dovish, like Waller and Bowman. You have people who are more hawkish, like Chair Powell. And of course, you have a lot of pressure from the president. So in this context, it seems to make the most sense to just, let's wait and see what the data says. And then the data could give me cover to do what I want to do. But that actually did not happen. Now, Chair Powell basically told everyone that he's going to cut rates in September. Now, the market was already pricing in a very high chance of a September rate cut, but now it really seems like a sure thing. Now, this seemed to have a very strong impact on the market. When you're looking at the rates markets, you can see that basically the whole rates curve rallied, right? Rates went down along the curve, including the longer dated rates. So for all you guys afraid that, if the Fed cuts rates, they'll lose control of the long end, blah, 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 that's just not how the world works. So Fed cut rates, that gets priced in throughout the curve. And 10-year yield came down notably as well. Looking at currencies, yes, dollar, massive sell-off in the dollar, and things that are indirectly related to that, let's say gold and Bitcoin rallied strongly. And of course, the equity market absolutely surged with the major indexes up over 1%, some almost 1.5%. So the market really interpreted this quite strongly. So let's talk a little bit about why Powell did what he did. And then let's also talk a little bit about the changes in the framework that he mentioned. So when you're looking at monetary policy, there are three dimensions in the US. So US, we have a dual mandate central bank. So first you have to look at employment, and then you have to look at inflation. And there's third dimension that is not often mentioned, but is just as important. That is, how restrictive is the central bank right now? So in this context today, there's not a lot of agreement on the Fed as to just any of these dimensions. So it makes it more difficult to act. What Chair Powell did is that he, I think, began to buy into a little bit more of Governor Waller's case when it comes to both labor and inflation. So first off, looking at labor, now Chair Powell has been pretty adamant that the labor market is strong, and he's been talking about things like, the unemployment rate, or looking at things like wages, quit rates, and so forth. Those are all fine. But he has to acknowledge that over the past few months, after the job revisions, the labor market is not as strong as they originally perceived. So monthly job growth numbers on average are pretty low. I think they're like 30-some thousand. So he acknowledges in his Jackson Hole speech that there's kind of more risk here. There's more risk here. So we got to be mindful of the employment mandate. We were saying to everyone that, the labor market is strong, but there's more risk there. And then when it comes to inflation, I think it's quite telling that on a year-over-year basis, inflation today is basically unchanged than it was last year. So progress on inflation has basically stalled. And in addition to that, we have tariffs that are coming in that will have some impact on inflation. Now, that some impact has been causing the FOMC some concerns because, if you're not at target and you haven't been on target for a long time, and then you have an additional inflation, that seems to have, that could have some impact on inflation expectations. So Powell was saying that, we have this dilemma and two things could happen. We could have potentially employees demand higher wages, and so as their wages go up, we could have some kind of wage price spiral like we saw in the 70s and 80s, and that's really bad. Or, of course, we could have, an unanchoring of inflation expectations where everyone sees that inflation has been high for a long time, begins to think that 3% is the new 2%, and begins to bake that into their pricing, and that leads inflation to continue to basically stay quite high. So he did not think that we could have a wage price spiral because, as he just discussed, there's downside risk in the labor market. And according to what he's looks at for longer term inflation expectations, he thinks that they're still anchored. So he's willing to say that, this tariff stuff, it could be just a one-time increase in the price level, as the textbooks say. Basically, it could simply be transitory. Now, we could have various companies gradually pass that on to the consumers over time, and it could come at different rates, vary by different industries. But, it's probably could be just a one-time increase in the price level. So, we've got to keep that in mind as well. So if you think the labor market risk is increasing a little bit more, you have to adjust your stance a little bit. Now, the third dimension is how restrictive you are. And this is a really hard question. Because if you're super restrictive right now, then yeah, you can say that I'll just lower rates a little bit. I'll still be restrictive, still be slowing the economy down, but not just as much because I want to balance my risks a little bit. Now, Powell himself doesn't think that interest rates are very restrictive right now. So he is hesitant to cut rates. But there are people on the FOMC who think that they are very restrictive. And so they're eager to cut rates a little bit more, not to be easing, but just to be less restrictive. Now, Powell seems to be willing to soften his stance, or at least compromise a bit on this, and say that, maybe maybe we could just cut rates a little bit and just, try to balance these mandates a little bit. Again, because you have three dimensions, there's a lot of discretion here. There's really no right, no wrong. It can be, in a sense, anything you want it to be. You can always make an argument. And so maybe this is to bowing to pressure on FOMC. Maybe it's bowing to political pressure. Maybe he himself is just, getting a bit more cautious because of what he saw with the labor market reports. But he's willing to cut rates in September. Doesn't mean he's going to cut rates again in December and November or anything like that, but means he's willing to compromise a bit. Now, the market currently is still pricing in just 2 cuts this year. So from a rates perspective, it's not a huge move for the Fed. So the market reaction seems to be overdone. But again, not everyone is a stir trader, and so depending on who you are, you could interpret this differently. And we'll see as we talk about the change in the FOMC's consensus statement, how there's a wide degree of expertise when it comes to looking at the Fed. Now, every 5 years, the Fed does a review on their framework, how they conduct monetary policy. The last review was in 2020, and that was a pretty big change in how they operated monetary policy, and it was a change in the operating procedure based on the low inflation and 0% interest rates they saw in the decade preceding 2020. So after the great financial crisis, interest rates were at 0, we had low inflation, and so the Fed thought that, maybe this is what the new normal is. And so they did a couple interesting tweaks to their operating framework. They said that we're going to do flexible average inflation targeting. However, it's going to be asymmetric. So what that means is that, sometimes if inflation, for example, were to run below 2%, we're going to be willing to let inflation overshoot above 2% for some time so that they would average at 2%. However, if inflation were to overshoot on 2%, we won't want to run inflation below 2% for some time to average it down. So it's asymmetric. We can run the economy hot, but we don't want to run the economy cool. Why did they have this procedure? It's because for the 10 years before, low inflation was the problem. The second big tweak in 2020 was that they also realized that they don't really know what the right unemployment rate is in the economy. Now, historically speaking, when the unemployment rate got too low, what the Fed would do was they would hike rates preemptively to try to head off the labor market from overheating. But what they saw in the decade after the great financial crisis was that the unemployment rate continued to go low, but you didn't really see any inflation and you didn't really see any wage pressure either. So that tells the Fed that they have no idea what the neutral unemployment rate is, and so they should not be hiking rates preemptively when the unemployment rate drops too much. Again, this is a framework designed for a low inflation world. Now, after 2020, again, we have the COVID inflation, and Chair Powell very, very candidly, very humbly acknowledged that he got that wrong. And I think that speaks to his character. He's definitely a person of integrity. So in this new 2025 framework, what the Fed is doing is that they're basically undoing everything they did in 2020. They're saying that we're not going to have this asymmetric flexible average inflation targeting, right? We're just going to, we're going to target 2%. And of course, we're not going to, so we're saying that we weren't going to hike preemptively in case unemployment rate went too low. We're going to take that out, right? We're going to go back to the old school way of when unemployment rate got too low, we're willing to hike preemptively. So that's really all they did. And there were some really, really bad takes on Twitter saying that, oh my God, the Fed abandoned their inflation target, so forth, blah, 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 blah. No, they did not do that. You got to wake up, right? You think the Federal Reserve would just, stand up and say that, I'm not going to do 2% anymore. Guys, that's not how the world works. And whether or not what they did was a policy error, I don't think so, actually. I think it's totally reasonable, given that the labor market is weakening, to adjust policy a little bit. And if you were expecting some sort of major policy error, you could probably see that in break-even inflations or something like that, but that you just don't see that. So I think that's just a fundamental misunderstanding about how U.S. monetary policy is conducted. Also, in related news is that the president's chief Fed watchdog, Director Pulte of the FHFA, has found some dirt on Fed Governor Lisa Cook on her mortgage application. So in the U.S., when you get a mortgage, you can get, if it's for your primary home, say the home that you live in, you'll get a lower rate. If you get a mortgage for a secondary home, let's say a vacation home, you get a higher interest rate. So Governor Pulte has evidence that suggests that, Director Pulte has evidence that suggests that Governor Lisa Cook got a mortgage for a secondary home, but actually claimed that it was her primary home so that she could get a lower mortgage rate. And now he's publicizing this, and the president himself has picked this up and thinks that this is grounds to fire Governor Cook. Now, I don't know if this will happen, but if it does, then you'll have more Trump appointees on the FOMC. This is something that will play out in the coming weeks. So very interesting. Again, if we have, let's say, if Governor Cook leaves and Trump appoints someone else, then he could soon have a lot more influence over the board. And if Jay Powell leaves when his term expires next May, then he'll definitely have a majority of Fed governors. And when you have a majority of Fed governors, you can do many things. In theory, you can even fire Fed presidents and replace them with other people as well. So we'll see how this happens, what's happening. Again, a future will not look like the past. How we run monetary policy today is not going to be how we did in the Great Moderation. Which leads us to our last topic, whereas the U.S. is also changing the way it's doing industrial policy. So the U.S. announced it's taking a 5% stake in Intel. Now, Intel is, again, a storied American semiconductor company. Most of you grew up using Intel products, but Intel, if you look at their stock price, has just really not been doing very well over the past several years. Now, their problems are numerous. First off, they missed a huge boom in cell phones, right? So Intel specializes in producing things like CPUs, the big processors for computers, but they didn't seem to realize that cell phones would take off, and so they kind of missed the bandwagon in producing chips for cell phones, and that went to ARM. And then they seem to miss the boat when it comes to GPUs. Now, GPUs are used in gaming originally, but now also used in data centers and so forth. And so AMD and NVIDIA basically ate their lunch. So Intel is just missed these two big waves, and their main processors, their CPUs, are also being outshone by AMD. Now, personally, I build computers, and now I use AMD processors in my desktops because they are simply better. So Intel is basically losing market share in a lot of things and also losing a lot of money. So its stock price has not done well. Now, the US, of course, has an interest in protecting their own supply chains. They don't want these key industries to be outsourced to Taiwan, to China, and so forth. And so the US has been trying to support key domestic industries. Earlier in the year, they made an investment in MP, a company that could potentially process rare earths in the United States so that the US doesn't have to be as dependent on Chinese rare earths. But now they made a 10% investment into Intel. These are non-voting shares. And the way that it's structured, it seems to be that the US basically was giving Intel grants through the CHIPS Act. But now instead of getting grants, basically just giving Intel money, they want something in return. Again, President Trump is a sophisticated businessman, so he doesn't just want to give a company something, he wants something in return. And that something in return is 10% stake, non-voting shares in Intel. Now, the non-voting shares is important because there's a lot of concern that maybe the US is taking control of private companies. And historically speaking, in the US, we have a perception that government-controlled companies, not good. That's a socialism. Government is very inefficient. And of course, there are potential corruption here. That's what we see in many socialist countries, right? Government controls a company and begins to use it for their own personal benefit, or at least the government officials do. So these are non-voting shares. They're not supposed to have influence over how Intel conducts its business. And in addition to that, they got a really good deal. Intel shares are trading at about $24, and the price that the government was able to acquire their Intel shares is much lower than that. So definitely, Trump got a really good deal for the US taxpayer. However, though, I think it's kind of interesting to note that, if you were to tell me that, for example, in Brazil, if you owned a Brazilian company and the Brazilian government came and bought a 10% stake in it, I'm not sure the market will react well to that, because when you have a government owning a company, the government's not really interested in making money, right? What does the government want? It wants to create jobs. It wants to, maybe make sure that things are produced in the US. Maybe that's not the most profitable way to do things, but of course, they're interested in national security. So it's not super clear why having higher government ownership in Intel would be a positive thing, but the market seems to really like it. I think if you were afraid that Intel was going to go under, having this government stake basically means that it's impossible for them to fail now. They would just get more and more bailouts. But if you think they're going to become more profitable, well, as we've just discussed, that's not really the top priority of the government. Now, I suspect that this is just the beginning of what could be increased government influence over certain key sectors. And they're really clear on what they think of as a key sector, right? It's rare earths, it's like steel, it's aluminum, semiconductors, and so forth. So this kind of more cohesive industrial policy on certain segments, I think it's going to spread. The market thinks this is positive for when the government takes a stake. I'm skeptical, but we'll see what happens. But definitely, again, future will not look like the past, and exciting times ahead. All right, so that's all I've prepared for today. Thanks so much for tuning in. Talk to you all next week.